Hi, good morning. This is Justin Talks Money. A lot of our clients have been asking about bank risk and contagion risk, and they're minded of the occurrences that happened in 2008. What is happening at the moment with banks like SVB and Signature Bank is actually really quite different. It's different because of a number of reasons. Some of the reasons are the rules and regulations that were put in place post 2008. It essentially split up US banks into the too big to fail banks and everyone else. Now, the US government has sort of decided that SVB and Signature Bank were quote unquote too big to fail. They weren't very big, but they had systemic risk because of the sectors that they were involved in. As you like. It specifically hasn't guaranteed beyond FDIC minimums or FDIC maximums of $250,000 smaller regional banks. So there may be capital outflows from them, but when unpacking them, the assets that these banks were holding were of a completely different character and quality to the problematic assets we found out about in 2008. So SVB wasn't primarily a lending bank. It took in more money than it could lend out and took that money and invested it in genuinely the safest possible thing, almost the safest possible thing, securities issued by the US government, which are guaranteed. Now, the risk that they had was a duration risk, which is a risk that happens when you have taken out a product that is too long, too short for your needs. What they had was a duration mismatch. Now, they had to, whenever you're taking in money and lending it out again, whether it's at a bank or private lending companies or whatever, you have to, and this is why private lenders are really safe, because at the moment they're taking money in for a term of 5 or 7 years or whatever it is, and then lending it out for about the same. So their duration risk is essentially zero. Now, the challenge for SVB was to try and match up their duration risk between the money coming in and the money coming out. The money coming out, they knew what the duration of that was. They wanted it to be a little bit longer with the US government so that they would get paid a little bit more, not so liquid. The other side of things is more complicated. What is the duration of a customer base of depositors who can take their money out anytime they like? Well, from one description, that duration is zero. Those accounts were instant access. They can have the money back whenever they want. But in reality, there is a duration. There is a duration that can be measured across quite wishy-washy social factors of how likely are the majority of people to continue to leave this money in. And actually, a loyal customer base is really valuable to a bank. They will leave their money with you. They won't demand a higher interest rate when interest rates are going up. And even when you've purchased a treasury that pays 2%, and that treasury value has gone down as central interest rates have gone up, you're still making money because your depositors are demanding basically zero. So you're still making money and you don't have to cash out that US Treasury early. It will mature in 3, 4, 5 years at par, and you will have collected 2% above depositor rates of about zero. That's the good side of things, and a possible explanation of why they thought their duration risk was fairly matched between depositors who they thought were loyal. SVB were specialists. They lent money to a specific group of people. They understood them. They had a relationship with them. It turned out that that wasn't the case, and SVB clients wanted their money back very quickly, and they weren't able to pay them. But that was sort of the maths that went on behind the scenes. Is there systemic risk? The answer is probably not, no. Are interest rate hikes hurting? They're hurting individuals, yes. They're hurting corporates that aren't banks, and they're hurting banks. But the quality of assets at the moment is absolutely, it's a quantum leap away from what they were in 2008. So that's something that's very, very important to understand. The asset quality is huge. And the other thing is that these banks that were deemed too big to fail have had extra demands and oversight put on them. So they have to keep even more, quote unquote, cash on hand. Their regulatory oversight is very, very strict. So when you talk of systemic risk, you're talking about some leak over into some of these systemically important banks, and that's less likely than ever. That said, clients are asking themselves, why should I hold a lot of money with a bank, especially a small bank, but really any bank, when I could be holding my money with, as an example, US Treasuries? If you have a larger than guaranteed deposit with even a big bank and that big bank goes bust, it's not like you're just getting your deposit back. You do have first call to get the rest of your money back, but it takes time. You don't get instant access to your deposits, and that can be a real issue for people, especially people who run companies who need that instant access. So they're taking money out, and they are facing a decision about whether to do that, take money out and go across and buy US Treasuries or buy other fixed income new issues. So bonds, debt that are being new issued by big corporates now, that pays better rates and that is seen as pretty safe. Systemic risk could have gone to private lenders, but again, their duration risk is very, very low. One other sector that I would highlight that may have a systemic overhang with regard to the rate rises, and the rate rises I don't think are going to continue at pace. I think that the market had priced in about 5.5%, and so it was a bit shocked when it got Jay Powell signals that it wasn't going to go really past that. So I think the market has stabilized from an interest rate point of view, but that rapid rise hasn't had an effect, or hasn't had all of its effect yet on all the markets. And one of the key markets is the real estate market in the US, which will feel long-term knock-on effects from rate rises. There will be people who have borrowed money at lower rates who need to attract buyers with debt that they're now that they're now getting at higher rates. And so we will see lenders, and I did speak previously about car lenders. We've got a lot of debt out there at very, very low rates. People are driving around in cars, which especially with the phasing out, really, especially in Europe, of fossil fuel cars, they will have end values which are lower than the lender initially thought. So the residuals will be lower, interest rates will be higher, and they're obviously locked in for that term. So they may take significant losses on those vehicles. These are things to watch out for. I don't think that bank contagion is really going to be much of an issue, although if there are alternatives like fixed income, why not take them? And that's all for now. Have a good day.